Good morning, good evening, good afternoon, wherever you are in the world. This is John with Tommy's Top Picks here to bring you your weekly flesh and blood market update. Let's jump right in. The market is less exciting than I thought when I was just putting the numbers together. I looked at the just the general changes that I was seeing, and I was like, oh wow, things are happening. But then when I looked at the percentage changes, it just isn't as impressive as I thought. So it'll be a relatively quiet week. We'll dig into some of that, some of the economic data that we did get over the last week or so, which is some pretty interesting stuff. We'll talk about that a little bit. And then I don't really have any cards to go over. I figure if I go over too frequently, it just kind of gets boring because it's like the same stuff. Things don't change that frequently. If you do want to hear about cards in particular, Stackswell, still recommend him. He's very good at keeping market updates fresh when it comes to different cards and stuff, and he reports when there's something to report. So subscribe to him and listen to his updates. He's way more thorough and aware than I am. All right, let's jump right in. Unlimited cases of crude down 6.2% to 274. I believe I called this last time. I'm sorry, I didn't see the top of this, but there's nothing there to report. The cases there, I just don't know that there's much to worry about here. We talked about this quick rise, and that would probably retrace this week. The good news is this retrace is still above the previous kind of angle range, whatever it was, up to 2, 3, 4 months ago. I don't really see any major concern here. This is a typical retrace that happens when it rises too quickly. I do think this is a good sign for upwards trajectory over time, but it will take some time for it to stabilize and push further from here. Moving on, ARK is up 11.79% to 1434 from 1265. Now, granted, this was 2 weeks of downtrend and it bounced back. This was a crazy number. I think I even called this out as a crazy number for ARK. It's all gone. I think there's 2 boxes down in this range, like 12 and 13 or something. There's several under this 14 number. They're gone now. We're back to 1434. This is where it really was. These were artificial. Like, let me see if I can dump the boxes. To note, and it is important to note, these were not sales. This did not sell at this price. It is not in the market history. So if you look at that, you'll see that it did not sell under this 14 mark. I have a feeling this was a BS number that someone was putting in there to try to convince someone else that that's the price, and then they pulled it. If it sold, they canceled the order, and then it bounces off this sold history. So I think it was a BS price, just so you know. I mean, we kind of called it a little bit there. Let's see. I feel like there was one other thing about WTR or something that I wanted to talk about very briefly. Yeah. Oh well. Guess we'll keep going. Moving on to Tales of Aria, down 5.53%. First edition cases we're talking about here, 199 from 210. No big deal, except for the fact that Tales of Aria case on both sides is 199, first and unlimited. That is weird. I don't like that one bit. Yep, don't like that one bit. They did say, oh wait, did they say they got rid of some of it? I think they did. Either way, I don't like that one bit. This has cold foils, this doesn't. It makes no sense. Not a fan, don't like it. Unlimited, what a mistake. I mean, they didn't know at the time. They were trying to do something. They were engineering for their own purposes that made sense at the time, but now, looking back, it's like, what a horrible thing. I have to track it separately. I hate that. So it makes my life inconvenient. Therefore, it's a huge mistake. I would just say that I think it is worth looking at what's happening in the general market. Overall, we are mixed signals right now. I do think that we will see continued mixed signals with an overall macro downward pressure because we are seeing some things happen in the markets that indicate a longer period of time of draining of capital from assets. That said, I believe it was Tommy or somebody in the Discord posted a video about, I think it was CNBC, honestly. I don't remember who it was, but they were basically saying collectibles were a new asset class, which I believe that's something I have talked about since I started the channel, or since I started this market update, rather, not the channel, that, there is a way to look at this as a differentiated asset class with a nice addition to your, I was thinking Sharpe ratio, but basically a nice way to be non-correlated to general markets. That said, there is some correlation, and that said, we can look at the correlation and come up with some ideas about how to act and interact with it as it goes. So I would just say it's worth keeping an eye on macro trends, and one of the macro trends that we have seen in the last week is CPI is up 0.1% over expected for this month. Now, I think it's up like 0.4% over last month, but that's not unusual. You have a drop in the early periods of the year and an increase as spring picks up. That is a standard yearly cycle thing, so it's more important to go over year-over-year number as opposed to month-over-month number. In this case, they expected this month to be this high, slightly lower, but like such a small amount lower that doesn't matter. So it's pretty much flat for expectations, which is a good thing because expectations are how the Fed decides on what interest rates should be and things like that. Markets are reacting based on expectations. It's interesting because a lot of the news picked up on this and kind of freaked out. Oh my God. And the markets didn't take a nosedive. They went down a little bit over the past day since this data came out. Oh my God, this is what's causing it. No, I disagree completely. And I'm no expert. So, listen to talking heads on the news all you want. If you want, feel free. I don't offer financial advice. I'm not an expert, but I have my own opinions. And my opinion on this is that the actual thing that's causing markets to stir and get a little concerned is the FOMC meeting where the Fed specifically talked about quantitative tightening being cut in half. Now, just as a background on what this is, quantitative easing meant that the Fed was, this happened way back in '08, but then it was used again in the recent pandemic period. They created new rules. I'm not sure exactly how it all structures or comes together, but basically they were permitted to buy up assets that were considered troubled or toxic that in the long run would be stable and secure. So basically prevent panic by holding assets that people were panicking about. In the '08 crisis, it was housing. They bought up a bunch of mortgages that were considered toxic with the concept that, hey, if we hold it long enough because we're the government and we can hold it for centuries if we have to, it will return us money. And in fact, that program in '08 returned the U.S. Treasury a boatload of money. Like, I want to say $750 billion profit on doing that. And the profit goes back to the taxpayer coffers, right? So this helped balance budgets and things like that, right? I could be wrong on the numbers. Please look it up. Correct me in the comments if I'm wrong, because I probably am. I'm like vaguely remembering the numbers. This was a long time ago. But it was a ton of money they put in. They used it to suck up all bad assets. There was a lot of complaints that it was printing money, all this stuff. It didn't do any of the things that printing money would have done because that's not what it was doing. It was securing weak assets that people were panicking on, and they were assets that had non-market values, or I guess the best way to put it is non-correlated values. Like, there was real assets there with real value underlying it if you ignored market noise, which was the panic of the time. That's the best way to put it. People were really panicking about bad mortgages, and this wiped out bad mortgages and bought them for pennies on the dollar and then reinstated them onto the market at reasonable prices. And guess what happened as a result? Hey, guess what? We made money as a government, I guess. So it worked out fine. They unwound most of that. I don't remember the exact time period, like 2012, 13, something like that. Flash forward to 2020, pandemic, etc. They used the same technique during that period. They bought up different types of assets. I actually don't remember what types they bought. I know it was different though. It wasn't like houses. It was different types, maybe commodities. I don't remember. I apologize. But basically, they bought up a bunch of assets as part of the quantitative easing that they implemented around the pandemic period. I think it was like late 2019 and on. Could be wrong on the dates. Don't quote me on that. But basically, what happened is they sucked up a bunch of assets that people were afraid of during that peak of fear during 2020, and they held on to it, and that actually rebounded relatively quick. There is some theory, and during this time there was some question about the math that was being used and the thought process that was being used, that they were too aggressive on that. And I personally agree with that. The bounce back was significant, kept the economy going, but it also dragged along some things that probably shouldn't have been dragged along. We can all debate the philosophy of this if you understand economics and how this all plays out. Otherwise, have no opinion, because it's wisest to just listen when you don't know anything about the thing instead of having an opinion you don't really have a reason to have. But when you look at it as a whole, that created a market fluctuation, which caused certain things. Honestly, some of the inflation may have been part of it. We'll see. I don't think the math shows that, but there's some argument to that degree. Now they've been quantitatively tightening, which is where they unwind those asset purchases. They sell off the balance sheet. I'm sorry, I wish I could give you better explanations and take more time at it, but this is not what the mainstay of this channel is about, so it would take a while to explain it all. But basically what it means is they took the assets that they bought up for safekeeping and to release back on the market as the market calmed down and stopped being afraid, and they started selling it. Now they started selling it at a pretty hefty rate for a while, and that's called unwinding the balance sheet or releasing the balance sheet, quantitative tightening, etc. This is the equivalent of unprinting money, if you want to go into the very, very simplest of terms on this, which isn't accurate and has all these loaded concepts with it that are just incorrect when applied this way, because math. But basically what it boils down to is they unprinted money. We'll go with the simple terms. And by unprinting money, when you destroy monetary supply, you decay inflation, right? Which is what we've been seeing. Inflation has been coming down. That said, CPI is up 0.1% for this month over what they expected. Oh my God, such a big deal. It's not. But what did happen, and this is the part that is the big deal. I'm sorry if this is taking a long time to explain, but it has some background that's necessary. They cut the rate of decline of assets on book by half. That's a huge number. And this is the part that people don't understand. When they do this, when they're quantitative tightening, we're talking billions, tens of billions to hundreds of billions on a monthly basis for periods, like 6 months, year, 2 years, depending on which period you're talking about. And then they unwind it over similarly long periods. So they then sell off those assets, to markets and basically, again, return that money to the Treasury, the U.S. economy, us taxpayers, right? Now, what does it pay? Our debts and stuff. So don't get too excited. You're not getting a check in the mail. But it does matter. It helps balance the books. They're reducing the speed of that sell-off, right? And they cut it in half. That is huge. And that, in my opinion, personally, from my butt, as we've said in the previous episodes, is a much bigger impact on equities and other places within the economy than this 0.1 CPI difference. That is, go look at the CPI number for the last 6 months and look how many times they were off from their guess by 0.1%. It's ridiculous. This is not a number that matters. What does matter is cutting quantitative tightening in half for the first time in 3 years, 4 years? I don't know. I don't remember when they started the tightening. It wasn't 4 years, because 4 years was when they started the easing. It has to be like 2 years at least. Big deal. I mean, this is a huge amount of money. We're talking from, I don't know that the number is 30 billion a month to 15 billion a month. That's a huge number a month. That makes a big difference in the flow of assets back onto markets and what that does to prices. It is also, and this is the big part that is most important and worth paying attention to if you want to move money around and think about it, not financial advice. That means assets aren't being dumped specifically because they're seeing a level of taming in prices, in inflation, in strengths of market, employment, maybe not, I don't know, but I'm not sure exactly what metrics they're looking at because they don't really talk about this part of it, which is unfortunate. I'd love to actually get some of the formulas and thinking on it. they're seeing weakness that is coming to a head, but not like a collapse weakness. It's like we're cooling off our drop because if we keep doing it too much, it's going to cause problems. And the comparison that was in the FOMC notes, you can go look at them, public record. Every news report on it too, is that they're trying to avoid the chaos in markets that was similar in I think they said 17 and 19. Those are two periods where they cut the quantitative tightening that was from '08, I believe. It was still that period. They unwound over such a long period, and it was one of those things that they cut it too heavily, or they didn't cut it fast enough. They were unwinding too quickly, kind of got in I don't know if it's deflationary. I'm not sure if that's exactly what that does, but it reduced the pressures on the market that should have maintained to a level. And as a result, it caused a lot of ripples through the market. I think this was the time period when the emergency overnight banking happened and they ran out of liquidity for that and they had to change the way that's structured. Either way, it's worth looking into. Please, if you have knowledge on this or if you look some stuff up and I said something wrong, please comment. This is all based on my fuzzy memory of years ago and things I wasn't super, involved in directly at the time. But I would love to hear other people's thoughts on it. Either way, it's a big deal to cut quantitative tightening in half. It does give a sign that there's strength in the market that's in a positive way, basically that they're coming to the end of the cool-off period. They're moving closer to reducing rates. They will not be reducing rates soon, though, based on CPI. And another factor that came in, which is very good for individuals in the economy, probably bad for inflation, but not that big of a deal in my opinion. I think we just got to get used to 3%. I think 2% is a stupid target. That's what it boils down to. They've said before it's an arbitrary number. I think 3% is the number, right? 3.5, something like that is a perfectly fine number. The reality is that the jobs report, which came out earlier this week, had 300,000 jobs added. The expectation was 200,000. Now all this gets corrected later. That's standard. It happens every month. Every quarter, actually. But the reality is that it was higher. That's a big difference. That's a 50% increase in the expectation. Jobs were added. Keep that in mind. That is labor costs, which does add to inflation, but not nearly as much as profit taking and that sort of thing, and stock buybacks and all the rest of the things that make me annoyed. But the reality is that is a huge indicator of productive economy. You don't hire unless you need to hire, especially in this situation where people were uncertain. We're getting to a point where uncertainty is disappearing. 3% is becoming normal, and people are getting comfortable with an interest rate of 4.5, 5, that kind of range as a core interest rate from the Fed. Reality check, it's going to cool off. We will see a little bit of a slow climb. That I think is the goal and the hope. And then as that happens, they'll probably cool off some interest rates a little bit to juice the economy a little bit, get things moving a little bit faster. In reality, the last 10 years have been somewhat irresponsible, and I think many economists will agree. This zero rate that was held forever, very long time, was not very realistic, not very practical. And this recovery / restructuring from that period has actually been way better engineered than most things. Now, will it work? We have yet to see. I know I've been talking about a recession for like a year and a half or something, right? Because all indications were there. All data showed it. Inverted yield curve. There's a ton of factors, and all historic data evidence pointed that way, but they avoided it so far. We'll see by the end of the year. I think we'll know, maybe next year at the latest. But I guess I said that last year, so take it with a grain of salt. All this is from my butt and not financial advice. So it's butt advice, not financial advice. So anyways, one thing that I did want to call is I think my butt did call WTR was ticking up. Yeah, it did tick up, only 3.79% though. It's worth noting that we were talking about this back here, that we start seeing this kind of move up, and it's moving up gradually. This is the sneaky part. Keep an eye on it. I do think we'll see some activity around this, and we started to see it trigger around this this box price, individual box price. This is for unlimited we're talking about here. Anyways, let's jump into some charts real quick. What's worth looking at? Oh, I guess let's start with WTR Unlimited. Yeah, see, here's this spike I was talking about. And we're sneaking. We're sneaking up. You see that sneaking up on the case? The case is following through. If we see this sneak up and hang tight here, I like it. And we'll see it move forward in a straight line. We'll be at a new level. And then before you know it, we'll be taking another step. Let's go and crew is nothing really special, but let's just take a look at it because we've talked about it for the past couple of weeks. Yeah, we're just seeing a correction back to the mean. Look at this line here. Whoop. It just dropped low. I think we're fine. Let's see where it lands. If it sticks in this area, I think we're in a pretty healthy spot. And this was just kind of like a doldrums. You can look here. The box prices stayed pretty stable the whole time. So this is just case availability, which I think will lead to an indicator of lack of supply when cases run out. I think they'll run out first. Obviously, people buy cases, they crack them, there's more boxes, etc. So I do think we'll see more volatility in cases before anything else. ARC, that's first edition, isn't it? Yeah. Let's see what's happening there. This isn't even worth looking at. Look at this. Like the line up here for the case is the stupid line because it's stupid. Yeah, okay. All right. I'm sorry. I'm ashamed I looked at this. Tales of Aria. Let's look at that. First edition is crazy low. God. Yeah, man. And this, the worst part is this number matches the Unlimited. That makes me so sad. That was my set. That was the set I was most hyped on. I got in with Monarch, but I was not on release. I was here for Tales release, and I was so into it. Makes me sad to see this like collapse at the time I came in. Came in at the wrong time. It's okay, I have stuff from older than that, but anyways, I hope you guys are out there cracking packs, playing games, and enjoying this hobby that we love, and forgetting about the financial aspect and actually just slinging cardboard and having fun. I don't play Fab so much anymore. I do play other card games. It doesn't matter. Play what you enjoy. Love what you play. Spend the time with friends and family that matters to you, and fill your heart with the joy of the people around you. It's way more important than the money. The money comes when you spend your time the way that's wisest and with people that you love. So anyways, until next time, I hope you guys have a good one.